Welcome back, folks. This is our weekend edition of the IGT Mentorship, October 26th, 2019. This is the economic calendar for the week to come. Obviously, there's an absence of any real volatility injections on Monday. On Tuesday, New York Open, dollar high impact consumer confidence. And Wednesday, we have German preliminary CPI. New York Open, high impact non-farm employment change, 8:30 a.m. advanced GDP. 10 a.m. we have the high impact Canadian dollar monetary policy report and rate statement. At 11:15 a.m. we have a press conference. So Wednesday's going to be very impactful for Canadian dollar. 2 p.m. we have FOMC, high impact for dollar, and Fed funds rate for the dollar. And again, FOMC press conference. So Wednesday is going to be very influential in terms of this week's volatility. On Thursday, we have the Spanish flash GDP for Euro, medium impact for London Open. CPI flash estimate, medium impact, 6 a.m. for Euro. And then GDP, high impact Canadian dollar, 8:30 a.m. New York Open. High impact personal spending for dollar. And price index and employment cost index and the Chicago PMI later on Thursday for dollar, medium impact. On Friday, we have manufacturing PMI for GBP in London Open. And that's really the only thing that pops up this coming week for British pound. And then on New York Open on Friday, we have high impact average hourly earnings and then our typical non-farm payroll, circus ride, and unemployment rate. Later on at 10 a.m. we have the high impact ISM manufacturing PMI. All right, so as a reminder, this is non-farm payroll week. The normal protocol is we look for our setups by Wednesday, New York Open. If there is no open position, we do not open a new one. And we let Thursday and Friday pan out as it will. All right, so let's go to the charts. Okay, folks, this is our dollar index. This is a daily chart. And we had our fair value gap outlined here. Dollar index has come back and filled in this entire fair value gap. There is a smaller one in here I want you to be aware of. That's this right here. And it would also take us up into this balanced price range. Now, ideally, we don't want to see it trade back here. Okay, I mentioned I didn't want to see this completely closed in either. I would have rather seen it come up like we mentioned on Wednesday when it came up, just tagged this candle's high. And then I would have liked to seen it start to move a little bit lower going into this balanced price range in here. We have non-farm payroll coming this week, and I'd like to see it stay within the range of this high and this low. And the reason why I would like to see that happen is if we stay in this consolidation, and then on Wednesday we have the high impact FOMC for dollar, that would be an ideal scenario to start seeing it make an attempt to go back below this low here and reach for the sell side liquidity pool. If we trade above this fair value gap ahead of Wednesday, we may be looking for a run into the buy side liquidity pool that rests here. Until we get above this fair value gap and trade above it, my focus is here. Okay, the intermediate term institutional order flow here is bearish. Nothing here except for running down below here, running these stops. To me, that's not sufficient enough. I think it would give more evidence that we would be running higher, which I don't see at this moment if we get above this. Okay, the reason why this is the factor is because if we look to the left over here, this balanced price range, remember I was talking about how it was going to require more energy to send it through, which it did on that candle there. And then we had our low resistance liquidity run conditions over here. We are up against this balanced price range, and this is reasonable. We had a nice imbalance. Price came back up. This was already highlighted anyway. Price came up, filled it in. And if we look at the equal lows here, if we trade a little bit higher than we have on Friday, a lot of folks will look at that as, okay, this is going to be support, broken, term resistance. I don't think that. I think if it's going to go higher, it's going to go to this. Now, it could go in, spike into this, close that up, and then look to go lower. That would be a scenario. I'd like to see that do it on Monday. If it's going to do this here, I'd like to see it do it on Monday immediately, and then come back inside the range, the fair value gap high, which is this candle's low here, and the low on this candle here. It probably isn't going to let me show it to you. I'll just show you this one. It's just a little bit lower than that. Okay, so 96.87, we'll call it. The long-term trend, I don't think that we're resuming yet. If we trade above this, then I'll look to revisit that idea. But right now, my focus still is here. And this is all reasonable price action ahead of this balanced price range. Again, if we make an attempt to go below here, there's a large pool of liquidity resting below here. And it would basically eat into the entire bull run of 2019 for the dollar index. Okay, so to me, it looks too rich down here for them not to want to eventually try to run into that. But we'll see if it gets there before the end of the year. Again, a lot of things can happen between now and then. It can still stay in this range. It doesn't have to go above these equal highs. It doesn't have to go below these equal lows. It can stay inside this larger trading range and just be more frustrating. For Euro, we're going to talk a little bit more about that, so we'll just get GBP, USD out of the way. All right, so we had a consolidation week. Nothing's really changed. We're hanging right below these relative equal highs. I still think this is a draw on liquidity, and then we may get that this week with the Wednesday and Friday related news, unless something comes out with Brexit and then totally changes it all again. I want to remind you that all of these candles in here, this has all been efficiently traded from the daily. But if we drop down into a 4-hour chart, no inefficiencies exist until we get down into there. Okay, so if we do see a strengthening of the dollar, this is a level I'd like. If we can get below this, okay, if we get below this, I will look for these relative equal lows as an objective, not for this week, but for the following weeks to come. That means all of this has been really just fluffed up, and then this could be just a market maker sell model. I don't know that yet. I'm not going out on a limb because Brexit. Okay, I've been very transparent with you all. I don't know what to expect every single day. I look at what price is doing on an intraday basis, and most of the time I'm not touching cable as a result. I'm doing a lot of paper trades, which I'm not even executing on a demo, but to me, it's just a completely new environment for me to learn in. So I know it may be very frustrating for some of you wanting me to be able to point my way through the price action of cable. I just know there's a lot of risk there. And I also know that there's a lot of you in here that aren't going to listen to me and say not to trade with live funds because you're greedy. And I understand that. So I'm taking that in account for when I talk about cable, because I don't want to see any of you get hurt. Not that you can't get hurt with other pairs, but it just, you've seen what we've done here in cable in the last couple of weeks. And if you're offside on that, it can really damage you. And it's my responsibility as your educator to protect you first. And that's number one, why we do a demo account only here. And also to remind you that if I'm not willing to put my own live funds behind this currency, that should be an indication right there. I'm not willing to do that because I don't trust it. It can do a whole lot of things completely contrary to what I would expect, all because of the Brexit related sentiment, and the central banks can use that as a smokescreen to do the complete opposite of what would normally be expected. All right. So with all that said, what am I getting at? Cable, to me, I want to see it make an attempt to get above these relative equal highs. Now, if we run above that this week, and then the dollar gives us a mirror image of what we'd expect to see. In other words, if it runs up here, dollar should go lower. Once we get above these equal highs, if it rejects that and trades lower, then our attention goes back to, if it hadn't already done so, this area here, the fair value gap on the dollar. Okay, so I'm trying to bring the two together to give you like a complete view of what I would expect. If we trade below this swing low, I would require this one, and then whatever low resistance liquidity run would form from that point here in price, not in terms of time, but in terms of price. I would look for a short in this area down into these relative equal lows. That is not what I expect at the moment. I'm expecting still a run above these equal highs on GBP. If we trade below this low, and only then, okay, even if we come down to these this candle here and fill in this inefficiency and the fair value gap is closed, I'm not buying that. Okay, I would look for that just to be a short-term rally and then sell off into the equal lows. That's what I would expect. But right now, initially, there's something in here that I'm hoping to see provide some support and then send it higher. I don't see it yet. I don't have any clue as to what it would be at the moment. It may form on Monday. It may form on Tuesday. It may require Wednesday's FOMC. I don't know. Okay, it's a wait and see. If you're in doubt, stay out, and that's what I'm doing. So let's go into a lower time frame. I want to take you back to our discussion on Wednesday. I mentioned how this. Let me just preface this also. I should have said this at the beginning of the recording. A lot of you don't watch the previous market review before you watch the new one. And invariably, you're trusting your memory. Okay, you're going to think about, oh, well, he said this or he said that. And many times you're taking it out of context. Go back and watch that recording. Okay, watch Wednesday's recording and then now watch this one. So if you haven't done so, or if you haven't taken extensive notes about the things I was saying in that video, and you're not referring to those notes as you're watching this video, you're really doing yourself a disservice, and you're also really going to take things out of context, and it won't be as beneficial to you as it will be if you do that. Okay, so the recording's there. It's unaltered. It's exactly what I said on Wednesday, and it is what it is. But I outlined this area here as a balanced price range. And the reason why I said that is because we went down, then back up, and then down again. So there's 3 passes between these 2 price levels. I mentioned that if we were going higher and we went through this entire price range that's balanced, if it were able to do that, that would be extremely bullish. Extremely bullish. Well, it went up a little bit, but only stopped at equilibrium. So essentially the midpoint of this balanced price range, it went to, and it did that at the time of the day where the Judas swing would occur. So we have relative equal highs, price runs up into the equilibrium area, and then sells off. So when this sells off like this, that changes everything, because it indicated that this balanced price range has an unwillingness to be broken beyond the equilibrium price point. So if it would have traded and gone back above here, then that would be extremely bullish, and then we would be looking for those equal highs from a relative standpoint. Let me see if I can pull it up from this chart here. Nope, I gotta go out to the daily. These relative equal highs here. Let me zoom in a little bit. So these relative equal highs we're looking for, I'm looking for rather, I think that's still a long-term draw on liquidity. And if we get some measure or a leg higher again, that's what I'd be reaching for an objective. What am I saying? I'm saying that had this broken, we were watching it go up. I said if it does entirely go through this entire balanced price range, that would be extremely bullish. Okay. If it can't do that, if it can't do it, then what are you left with? And now I'm going to bring in some algorithmic theory. if we have a outline of what we would reasonably expect to see price do, and we were watching and studying to see if this would give up the ghost, in other words, was price willing to completely pass through this balanced price range? Because if it did, it would be remarkably bullish, because all of this sell side would have been completely rebalanced and then allowed to go higher. This equilibrium level, which is midpoint from the balanced price range high and the low, go back and watch Wednesday's video. You'll see why and how I did that. What makes it a balanced price range? It went right to the midpoint of it, equilibrium, and then it broke aggressively. Now it traded lower, creating an imbalance in here. So we have a SIBI, sell side imbalance, buy side inefficiency. Okay, price comes right back up to it, completely perfectly balances it during the New York session. Relative equal lows, relative equal lows, relative equal lows. Sell side liquidity pool. Then price aggressively runs lower, and then even sweeps the big figure at 128 down to 127.90. So we had a 50 pip draw from the equal lows all the way down here. This is a big move. It doesn't look like that much of a move because you're looking at it like this compared to all this. But this is actually this is like a one shot, one kill by itself. I wish I would have taken it. I didn't. I did not take this. I didn't trust it. And like I said, I'm keeping hands off cable because there's a lot of things that I'm still seeing in price action that are normal signatures, but I'm respecting the overall conditions of the market, because all it takes is someone to come out and say, hey, look, the Brexit is never happening because of this, that, and the other thing, or Brexit is going to happen because of this, that, and the other thing. And as soon as that hits the wires, the central bank will do the opposite of what you think is going to happen and then reprice. It's not the buying and selling that's causing these fluctuations. It's not. So because I know that the conditions are ripe for that level of manipulation, and it can get really crazy. I mean, they can send this thing hundreds of pips in an instant, and I don't want to be offside on that. So it's still good for learning. It's still good for practice and study. But man, I'm telling you, if you are in this pair monkeying around with it, you're asking to get burned. You are asking for it. So I don't want to see emails from anybody saying, well, I didn't listen to you, I got burned, I blew my account. I don't want to see those things. But if you're sober about it and you're respecting the risk, like I'm trying to convey that to you, because I'm doing it too, this study of the low resistance liquidity run was only viable because of the balanced price range offering stiff resistance. Remember the idea, go back and watch Wednesday's video, if it can go all the way up through the balanced price range, once it does that, that is hugely bullish. But if it can't do it, what does it mean? Well, then everything changes. So from an algorithmic standpoint, we had a if statement, IF, okay? If we can trade through this balanced price range, that would be extremely bullish. That extreme bullishness would lead us to believe that the next level would be up here. But let's go back down into this level. If it could do this, trade all the way up here, it's bullish. But if it cannot do it, what does it indicate? You have to look for discount. What levels of discount would exist? Well, you really wouldn't look for it until we get the break in market structure here and then the rebalance. So at this point here, what you'll be looking for from a discount array, you'd have the relative equal lows here, relative equal lows here, and then the larger pool of liquidity here. So doing 10, 20, 30 pip sweeps below this could take us down to 128.10. That close to the big figure, well, you know the protocol. It can sweep through that. And this could have easily, with all the conditions that are around and the environment around the UK and the Brexit, GBP could have hit 128 and then spread 50 pips below that down to 127.50. And that would not have surprised me at all because of the underlying risks associated with this pair right now. But as it were, price did have a nice low resistance liquidity run down to a big figure, and we're consolidating here. Now, if this consolidation sees us rally, because we do have a little bit of buy side liquidity here. Anything that's been trailed from shorts, they could come back up there and clean that up if the dollar rallies to that daily fair value gap that has not been traded to yet. Here we could see cable trade up into this little imbalance there, which would be right above these equal highs and just below this low here. You remember, everything's going to be viewed as, okay, this is support broken. It's going to trade right back up to the bottom of that low, okay, or trade at the bottom of these candles here because there's more bodies there, okay. That's what retail is going to expect. I wouldn't expect it to go all the way up there. I wouldn't need it to. It could go just to this area here if the dollar trades to that daily fair value gap. That would be another area we could see another round of selling on cable. I'm studying it. I'm not demo trading it. I'm not live trading it. I'm paper trading it. I'm just looking at if that's what they would be willing to do, because that, if I was making the market for GBP, that's what I would do. I would personally take it to this area here, rebalance, take all the buy side liquidity and make a run for this low here and go a little bit deeper into 127.80. That's what I personally would do, but I don't make the market for GBP, but it is what it is. That's all I got for pound. I don't want to give any more than that because it'll just entice you to do more things with it, and I don't want you to hurt yourself. So let's go over to the euro, and we'll start with the lower time frame. This is a chart with additional price action, obviously, since Friday. All of this markup in here I gave by way of Thursday's post to the forum, and then we have Friday's price action in here. Now again, go back and listen and watch the recording on Wednesday because I gave you a condition for euro. I wanted to see the buy side liquidity pool above these relative equal highs. I wanted to see that attacked, and I wanted to see it when ECB came out. I wanted to see the gap that was here left open, and I wanted to see it occur on the heels of ECB going into Draghi. That's what I wanted. And we didn't get that. We actually got it early. Okay, so I'm going to give you another if-then algorithmic theory. I outlined it very clearly. All the context is in Wednesday's video. I wanted to see this gap left open. I wanted to see it run into this area here during the ECB related news. Then I wanted to see Draghi talk, and whatever he would say, I could care less what it is, he said, but the fact that he was flapping his gums would be enough to send them looking for a higher price in euro on its daily chart. Neither of those conditions occurred. We had a run to the liquidity pool, which was outlined, and it was a 30 pip run, but it occurred at the wrong time, and it was ahead of the volatility injection because of ECB related news and then Draghi. So if they run the liquidity that we were looking for as the first objective in a run higher, what have they done essentially? Well, think about it like this. Again, algorithmic theory. If price can hold a gap here and then run up into this liquidity pool during the 8:30 hour, or I'm sorry, it was like 7:30 or whatever it was, and then at 8:45 when Draghi was the talking and do his normal thing, we could see a continuation and run into that 112 and it spread up into the 112.20, 112.40 level. Okay, but it would require Draghi to talk the right way for the banks to have that smoke screen, and then they would reprice euro, accordingly. Since we did not get that, so if those conditions were there, which they did not present themselves, what are we left with? Though, okay, if this does this at the right time and the price is delivered the way we were expecting, we would expect further upside. But because it did not, we have another if statement. So if it doesn't do that, what are we left with? We have to look for that daily fair value gap on the euro. And let's go out to a euro chart, and I don't want to give you any additional notes on that because these notes I want to save. So here is the euro. So if the bullish condition that we outlined, while it still offered pips on the upside, and they were all manageable setups. You could have taken 25, 30 pips out of these moves. The larger daily chart in this imbalance here that we talked about, I said if the Draghi related ECB announcements was unable to send it higher above this high here, that was the high I had outlined. Remember I told you I had the line, I said it wasn't anchored on anything over there. It's just this high here. Well, if we were to trade through that, then our attention would have been taken over here to these relative equal highs. But the statement was, if it cannot and it goes lower, if it can't go higher, it will go lower. And to where? I gave you a specific condition. If it doesn't go higher on the Draghi scenario, all the ECB stuff, I gave you the things that I was looking for from the signatures. I wanted the price run above the equal highs to happen during the Draghi related portion of the day. If it does it ahead of time, it's lower probability. Because it didn't do it, this was going to be the rebalance point. I said, okay, then it'll go lower, and all of this would be rebalanced. Again, go back and watch the first maybe 7 minutes of the video from Wednesday. I think it'll do it. If not, just watch. Make sure you watch the whole portion of the euro. So let's go back into the 20-minute chart here. So since it did this early, while the price offered a tradable run, it does not fit the narrative that I was giving you on Wednesday. So if this does not occur, what are we left with? We're left with another if statement. So if this doesn't produce the run that we were looking for, then we have to turn our attention to that daily fair value gap as a downside draw on liquidity. Here's the top of the fair value gap, that line here, and here's the low end of that fair value gap on the daily chart. So that's what these levels are highlighted here. Okay. I also stated in the video, and I think it's the 4-minute mark or so, I said if we take out Wednesday's low, we will see the complete filling in of that daily fair value gap on Euro USD. Here's Wednesday's low. It runs it here. Okay. Thursday we run through it. Great. Maybe you didn't take anything here. Maybe you didn't sell it in here. Maybe you didn't do the institutional order flow entry drill technique here and capture pips. Okay, great. Who cares? Fast forward to Friday. We had consolidation. Price runs right back up into mitigation. In this area, we have a rebalance. This area here is also equilibrium of the price run from here and here. And I'll give you notes in a moment. But we have the fair value gap closure here, and then it runs a little bit more lower than that. Here is the amplified notes. I have a fair value gap here from this high to this low, equilibrium. It returns right back to equilibrium, runs buy side liquidity. So we go up to a fair value gap into mitigation. What is mitigation? All of this running here, anything they use to go long, they have to undo that, and that's what mitigation is here. And then price comes down into New York. Let me scrunch this up so you can see the full thing here. Here we are. So this is the New York kill zone, beginning of it. We have a SIBI, sell side imbalance, buy side inefficiency. That's the protraction on New York. Trades down again. Now watch, look close, okay? Even on this 15-minute time frame, see all this back and forth price action in here? All this back and forth price action is the same thing that I've outlined on the higher time frame chart for the dollar. Remember I was talking about it over here? All this back and forth price action, that's a balanced price range. Well, the same thing is existing here, just on a smaller time frame. So that's why when we see this price run back up into this level here, it's butting into the bottom edge of that balanced price range. So look how much time. It wasn't one single candle that passed through this entire range. Let me highlight that so you can get a real good understanding of what I'm saying here, because this is crucial. If you don't understand this, you're gonna really you're gonna struggle. Okay, you're gonna have a hard time really appreciating the things I'm showing you when it's not a low resistance liquidity run. All of this back and forth price action, it's balanced. Look how many candles it took to get through all that. And then once we got to the bottom edge of that, then boom, look out, let me zoom in. All of this back and forth in the shaded area, we have 1, 2, 3, 4, 5 candles, okay, an hour and 15 minutes, and then one single candle, once we get to the bottom edge of it, and then it expands, creates an imbalance. That's when your setup occurs. Refill, rebalance, bottom edge of the balanced price range. There's your New York setup. And then expansion lower. Then we get another SIBI, sell side imbalance, buy side inefficiency. Consequent encroachment trades right to the middle of that, sells off again. Down into 110.72 and a half. The lower here was 110.92 and a half. Exactly 20 pip grade price run below this low here. So let me zoom out. Wednesday's conditions outlined in advance. We wanted to see specific things occur, but because it happened early, our original if statement, if the conditions are ripe for a higher price move, time and price have to agree. We also have to see certain measures of price create a signature that we've seen many times before that will align with our understanding of what it may do on the higher time frame. Wednesday's low was taken. Let me put the daily dividers back on again. So here's Friday, here's Thursday, and here's Wednesday's low. Wednesday's low was taken. I told you specifically in Wednesday's video that if we take Wednesday's low, we will see a full closure of that daily fair value gap. Now, did it do it on Thursday? No, because here's the bottom end of that fair value gap. Right here, the daily fair value gap, the low of it, that's this candle's high. Okay, right there. If we break Wednesday's low, which we did, our attention would be, okay, we can't expect a higher price. That's now out off the table. So we're left with, okay, if you only wanted to be a buyer, then you do nothing. Or you adapt and you say, okay, well, the next draw on liquidity is that daily fair value gap. But the things I'm outlining that would get you in another trade pan out. Now, obviously, that sounds like, well, of course, anybody could say that. If it's not going to go up, it's going to go down. The specific conditions that we look for are the signatures I'm trying to teach you. So if you don't look at those things in the proper context, you're going to miss the understanding and the learning from it. Now, let me scrunch this up again. So we have this price swing on Friday. Okay, we have, it's not quite an optimal trade entry. Okay, if you look at the mitigation block right here, trades up into it really nice. Now, you could go and say this is a breaker because it's running a short-term high. I would not call that a breaker. This would be a mitigation block. And why is it a mitigation block? It's because we have a high here and it rolls back up into what would be like an optimal trade entry, and then it breaks that low. This is mitigation. Now, if this was reversed, said this high was higher than this high, then this would be a breaker. So that's the distinction between the two. Okay, I got an email a couple weeks ago. What's the distinction between a mitigation block and a breaker? They are both mitigation by nature. They're mitigating what was used when price was going up. Any positions that they offered as counterparty, because not all of this run is attributed to them buying for the sake of making money going up. They're buying to be counterparty to institutions, commerce, large insurance companies come in. They have to do transactions, global commerce. All those transactions, they're going to need to get off of that because they're holding the risk. So to get out of that position of holding the risk, when it comes back up here, it allows them to mitigate that. Okay, but this optimal trade entry, the low in between is mitigation, or simply the mitigation block. If we have a high, a low, and a higher high, the down candle at the lowest point of the swing low is a specific breaker. Now, what's more stronger? You're probably asking yourself, what's more preferable? Should I look for mitigation blocks or should I look for breakers? Breakers are better at determining when there's going to be a large magnitude move because they've already run stops. Okay, they've already ran stops, and when you trade back at the bottom end of that range, you're going to see a much more sharper responsiveness, and then there's going to be a lot of range because they've already done the dirty work. In instances like this where we have a mitigation block or a traditional optimal trade entry short, you can see a little bit slower, more lethargic move, but it'll still move and it's tradable. But the distinctions between the two, if it was just a plain mitigation block versus a breaker, breakers tend to have a sharper, quicker responsiveness in price action, and they usually want to cover a lot more ground because they want to leave the area that was the crime scene. Basically, mitigation blocks they can actually come back up again and hit that, and then you start to see it work its way lower. If it's a personal preference for me, I'd like to find a bearish market structure on a higher time frame chart and then look for bearish breakers, and then I'd have a high probability short scenario. That's my personal election for trading them. But if I've already had that on a higher time frame, like for instance, say the daily's bearish, and then on a 1 hour I have or not so much a 1 hour, say it's a 4 hour bearish breaker, I could look for a 1 hour bearish mitigation block and still be in sync with what I expect to see on the daily and the 4 hour, and still have a larger magnitude move. But that's how I would use the mitigation block. It would have to have some higher time frame backdrop behind it. Then I would be more inclined to trade with my maximum risk. Otherwise, it's not as probable. Not that they aren't good setups. They are good setups, but they're not probable for big magnitude and fast delivery, whereas a breaker in most instances will deliver that. All right, so fair value gap filled in New York session, and then we had a smaller SIBI, and it came back up to consequent encroachment there, and then rolled over, and again 20 pip run for a stop raid on sell side liquidity here, and complete closure of the fair value gap at this candle here, and we still went a little bit lower for good measure. So if I was to look at a clean chart, let's go into a 15-minute time frame on that with no notes on it. Okay, we're right back in equilibrium of this price range here. We hit that. If we get dollar strength this week and we go up into that unfilled daily fair value gap, again, this one here, if we have that occur, euro could trade down to here. Okay, we have relative equal lows, and then we have this fair value gap right there. So it would require not much. It doesn't need to rally up here. If we get immediate strength on Sunday's opening and going into Monday for dollar, that would just send this thing lower. It's got a lot of distribution going on in here with all of the rallies being sold off. Lots of obvious liquidity resting below here. So that would be the near-term draw for me here. I don't see this one yet. It would have to depend on how we trade here if we get to the fair value gap at all. But if we get below that, then I think this would be the next level to be concerned about. And then if we get down here, that's it completely changes the picture for me for the dollar. That would probably mean we're going for the daily buy-side liquidity on dollar here, and I don't see that yet. All of this in here looks like it's dropped down. They're fluffing it up ahead of FOMC and non-farm payroll, and then I wouldn't be surprised if we see it really make an aggressive run into here after non-farm payroll, after FOMC. All those factors have to be that bridge has to be crossed. All right, so in last bit of business, I had a bearish slant for dollar CAD, aiming for the relative equal lows below here. And we had erosion last week. We only had one up day. Let's go into a hourly chart and daily dividers. So we had Friday, ugly mixed day. Thursday, we had a nice return back to a fair value gap in here, and it sold off. It offered some pips, but look how difficult that is. Okay, look how hard it's trading to go lower. We had a nice fair value gap on Tuesday, trade up to consequent encroachment, sold off, came back, rebalanced, and lower again into Thursday. Thursday creating the low of the week on New York Open, classic weekly scenario. Even though it doesn't look all that stunning, it's still, those signatures are there. Go out to a daily chart again. All right. And again, all of this back and forth price action, okay, same thing, balanced price range. Contrast that with like a singular, like a V, they call it a V bottom, okay, or a single stop low where it goes down and comes right back up. We don't have that here, okay. We have 1, up, 2, up, 3, up, 4, up. It's a lot of, that's a balanced price range. Again, what I'm teaching you is understanding the ebb and flow that's going to occur between all this. Okay. Actually, let me draw that a little bit more because there we are. So to get through all of this down, like say we're up here and we think it's going to go down here. Say we were at this point here. Say we were thinking it was going to go down here. It can move quickly, stall a little bit, and then run fast right below this V bottom type single pass low. In other words, it was like a run time go down and then go up. The price will have very little resistance in that. This is a low resistance liquidity run. This is a high resistance liquidity run because we have up, down, up, down, up, down, up. You see what I'm saying there? All that shaded area has been offered back and forth. So price is not going to have a very free, fast, low resistance scenario to go lower. While even though that's where it may very well go, and I believe it will, it can't get there quickly because it's passing through a level of high resistance. Okay, imagine trying to run against hurricane force winds. Okay, you could drive your car through a hurricane, head on with hurricane winds, but it's not going. You would feel it. I mean, even on a windy day, you can feel it. If you go across a bridge, a high level bridge, and you drive across it with your truck or your car, you feel that resistance of the wind. Okay, you're not going to go as efficiently and as quickly as your car would normally go if it wasn't encountering that environment. This balanced price range where price is back and forth, back and forth, back and forth, it makes it difficult, not impossible, it makes it difficult to trade down, and you have to have a different mindset. This is what I'm trying to communicate to you for the last 2 weeks. When you have these scenarios, you have to be extremely patient, and you can't be quick to jam your stop loss up to break even or try to protect something. You have to give it some time, and you got to give it room because it's going to go back and forth versus a low resistance liquidity run where you can get in a trade. As soon as it gives you first profit, put your stop at +1 or break even and just let it go because it's going to be quick to get to your profit. High resistance is not that way of delivery. It's completely alien to that. It will not offer that. It's going to be a completely different paradigm. You're not going to have that comfortable feeling. It's very hard to trade in these conditions. The only benefit that I'm trying to illuminate by bringing all this emphasis up about it is there's a lot of you will look at this and say, okay, this is going to be a low resistance liquidity run because it has equal lows, and that's a low resistance. I mean, there's people in chat rooms that think they understand how I trade, and they're outlining things on charts that, and then they're complaining and they're cussing to their friends in this chat room that it didn't pan out right because they don't know what I'm teaching. I'm teaching you high level stuff. This is top tier analysis. If you don't spend time with this, you're going to lose it. I'm telling you, you're going to lose it because you're going to look at every scenario and label it as a low resistance liquidity run and then get completely ran over by the amount of time it takes for those moves. And it's either going to change your opinion about it, you're going to get stopped out because you're going to get impatient and afraid to lose, and you're going to push your stop loss too close, or you're just going to get out because you can't stand waiting anymore. And then it's going to move where you thought it was, and then you're going to send me an email and say, what's going on? What am I doing wrong? I'm teaching you how to look at it differently. That's all it is. Your perception of price is what's lacking right now. That's what led you to me. You don't know what you're doing. You see me doing things, and you want to look at the market the way I look at it. That's what you're paying for. I'm teaching you that. You all signed up for a mentorship to learn how to look at price action, and that's what you're getting. But you have to go through these periods, and I'm holding your hand the whole way. I'm explaining what's about to happen and why it's going to be hard and why it's not going to be doing exactly what you would normally expect it to do in a low resistance liquidity run. Know that this is going to be a reoccurring situation for you as a trader. You're going to have periods where you'll see these scenarios, you'll see these setups, and you expect it to trade down there. And then you'll see other scenarios where you have like this condition where it's a single pass, like a V bottom low or a TP top, like where it creates like these singular highs where it's not like a whole lot of this business. I wouldn't touch this one because all this was a stop run above these equal highs. But when you have like these single passes where it's a high or low, swing low or swing high, below that swing low, it's an easy sell side liquidity pool. Above a single swing high is a buy side liquidity pool. It's a low resistance liquidity run for that. If institutional order flow on a higher time frame supports that. Institutional order flow could support this, which I think it does, because if you look at a daily chart of the Canadian dollar futures December contract, you'll see that there are equal highs on the Canadian dollar futures chart. And that's going to be a mirror image of what we're seeing here on the dollar CAD because it's inverted, because the pair begins with dollar. And if that's what we're expecting on the Canadian futures, higher run on buy side liquidity on its daily chart, it's going to be a run on sell side liquidity on its daily chart on this pair. Okay. And it's just being met with high resistance. So I just want you to understand that there's a strong contrast between what you learned in month one and now learning this. So you're probably asking yourself, well, why am I spending so much time talking about it? If it's not good, why should we spend any time with it? Because I want you to understand, if you know what these signatures are that makes it a high resistance liquidity run, doesn't it make it easier to not trade in these conditions, and then also highlight the times when it's going to be high resistance to stay out of the market, not trade that pair, and look for the low resistance liquidity run setups and pairs? So it's beneficial. You're just not finding the value in it because I haven't told you the benefit of why we're spending time in studying it. If you know that there's going to be a problem, okay, there's going to be a pitfall ahead of where you're at right now, doesn't it make sense to know the last time you went that way, it hurt you? I've done this for you. And I'm telling you, the problems you're going to incur and the resistance in your learning and where you're going to hurt yourself financially is you're going to look at conditions like this. And while they still pan out, if you go back and look at your trades where you collapsed them early and they still panned out in your favor, chances are it was the high resistance nature of the setup that you encountered but didn't understand. So that's the epiphany that you're supposed to be having with these discussions that we've been having for 2 weeks now. If you don't get it yet, it's okay. By watching these examples, and I'll bring up more of it, as time goes on, there's always movement in price. Okay, there's always up and down movement, and you're always going to find setups. But every setup is not the same. There's going to be a high resistance nature to it or a low resistance nature to it. The easiest cherry picking, taking money off of the tree, okay, that type of scenario is in a low resistance condition. And when you can draw a distinction between what a high resistance setup is and a low resistance setup is, then you will know when to sit on your hands and wait for that. And also see something that's there, even though you know it's likely to occur, I ain't taking part of it. And that's where that patience aspect comes in. A lot of you ask, how do I develop this patience of waiting for setups? Because you see a lot of things happening and you want to get in the market every single day. Or how do I handle losing trades? Well, if you get stopped out in this environment here, it's directly related to the fact that you jam the stop up too tight and you're not giving it a lot of freedom. It needs a lot more room and freedom, which is the other reason why I don't like trading high resistance liquidity runs, because I like to have my stop managed reasonably, okay, and I also want to be able to move it a couple times before profit, or where my terminus would be, where the final profit objective would be. In high resistance liquidity runs, it makes it more difficult in stop loss management because there's many times it'll come back multiple times, and you can see that type of action in here where the wicks are going back up into the range that's already been traded. I don't like to see that. I like to see the market immediately snap in to a movement away from my entry towards my profit, and I want to see speed and distance. Okay, when you watch my recordings, when I'm recording my live trades and I'm executing over the market, most of my time in commentating is focusing on communicating. This is what I'm looking for. What signature am I looking for? I want to see it move quickly, speed, and I want to see distance, how fast it can cover and spool. I want to see it move away, the magnitude. Because if I can see speed and distance, I'm on side. I'm not offside, I'm on side. Offside, when I'm in a market move and it looks like a low resistance liquidity run, but it behaves like a high resistance liquidity run, listen to this now. If it's a low resistance scenario like this, but it starts behaving like a high resistance where it's got a back and forth, back and forth, back and forth, I will bail on that trade. And I don't care if it ultimately goes down and goes to my objective. I'm okay with that. So it allows me to classify specific market profiles and conditions in price action where it allows me to, okay, I'm comfortable holding this and leaving my stop a little bit open in terms of the risk because I have to allow the trade to develop a little bit more if I'm willing to trade in a high resistance liquidity run. It's very infrequent, but I've done it. If I'm in a low resistance liquidity run where it should easily run to my objective, run a level of stops or run a level of buy stops or sell stops relative to whatever direction I'm trading in that particular market, and it starts behaving like what we're studying in a high resistance liquidity run, then that trade becomes highly suspect and I'm probably offside. You get what I just told you? It gives you clarity. It will tell you you're wrong and you either got to cut risk or cut bait and completely get out of the trade and not have any reservations about it, not be upset about what happens after you do it. Next trade. That's how you develop the mindset for this, because if you don't do these things, it's going to be very difficult for you to develop beyond just hit and win, hit and win, hit and win, and then string of losses completely wipes it away because you're going to lose your mind. You all knew how to find good setups, but the problems are going to be like these scenarios here where it will look like it's supposed to move fast and low resistance, but it's changing its condition. It's like a chameleon. Okay, it changes its color. Everything looked good when you first got in the trade. Maybe you've gotten an opportunity to take first profit, but then now it's starting to behave like a high resistance liquidity run. As soon as it starts doing that, I'm done. I'm out of there because I know what's going to happen. I'm going to spend mental capital. Okay, I don't want to waste my time worrying about if the trade's going to pan out, because as soon as I start worrying about whether it's going to pan out, I'm pulling the plug on it, because I don't waste time doing it. I don't feed my mind with negativity. I don't give myself any opportunity to think about a trade potentially going awry and then hurting me. I don't think that. Every one of my trades, when I enter them, I'm a losing trade right away. All of us have to overcome the spread. All trades start that way. But if I go to a state of profitability and I take first profit, if that trade at that time becomes a questionable or suspect setup, I'm done. I'm pulling it. I'm not worrying about it. There's too many other setups that will offer me low resistance liquidity runs, and it'll move with speed and distance, just like that. And that's what I'm doing. That's what gives your money, your account balance, velocity. I want velocity. I know how to find liquidity, and I know how to time the volatility, but the velocity that's required to multiply and parlay your account balance happens by constantly putting your money in fertile ground. If the ground stops yielding nutrients and soil, whatever you've planted isn't going to grow. It's going to stagnate and dry up and die. Money seeks yield. You as an investor, that's your goal. You want to learn how to do that. That's what I'm teaching you. I'm teaching you how to discern the difference between a low resistance liquidity run condition and a high resistance liquidity run condition. There is a completely different mindset required. And some of you, as strange as this may sound, some of you will probably like this over a low resistance liquidity run. I've seen it before. It's completely surprising. I wouldn't be surprised now because I know it's happened before and when I've taught other people. But some have said, you know what, these setups, I'm comfortable with it. I'm patient. I'm going to let it happen. That's just not me. Okay. I'm not that patient. You think I'm extremely patient? I'm not that patient. So just know that this is a topic that we're going to revisit as more availability makes its way into price action. But you have to understand yourself while going through it. Because if you're watching the dollar CAD and we had a down week as a result of the analysis, everything's panning out slowly, but it's panning out. You have to record these feelings. You have to record them in your journal. And this is moving at a slower pace than I expected. Not saying, man, this is taking forever. It's like watching paint dry. See, I said the same thing, but the second one is emotionally charged with negativity, whereas the first one is objective. This is panning out slower than I expected. How can you get upset about that? That's just a normal occurrence. You were on your way to work and you got into a traffic jam. It's a nuisance. What are you going to do? Well, I know what you're going to do. It's the same thing I used to do when I was in that stuff. I would cuss and rant and rave and beat the horn and make up all kinds of reasons why I could yell at the steering wheel. And it didn't make me go any further or faster down the road. So in your development as a trader, complaining about the situation versus noting and observing the signatures about what it is you're seeing in price, that's how you gain the access to the insight, but you don't withdraw all the negative view about it, because you don't want to feed your brain with negative stimuli. Okay, negative stimuli will turn you into a toxic person, and you'll always look for that negative side of things. Okay, and if you're developing, you're never going to be what you would hope to have been if you think like that, because you're just completely broken mentally, and you're just constantly feeding yourself negativity. Whereas if you look at it objectively, and you take everything as a learning experience, and you take it with a sober, objective mindset, you'll get what you're looking for, and you won't hurt yourself in the process. And that's my job. I need to protect, number one, all of you, show you how to gainfully glean all the insights that's available to you, and then give you a structured approach on how to use it all. But you have to know what these pieces are before I sit down and say, okay, you're going to do this, 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 and this. Because I can give you that outline. I can do that. And some of you are going to tell me, I'm ready for it now. And you're not. You're not. Some of you think you're mental giants. And I'm not trying to be ignorant or trying to talk down to anybody, because I don't claim to be a mental giant. But I'm telling you, you don't know the things you need to know to put this stuff together completely. You have all these moving parts. And just because you know a couple signatures, and while they're independently very unique and very powerful, you have to know how to purposely build a model and a plan where they're used in a model that is effective, efficient, and it's solid, it's sound. You can have bullish order blocks and breakers and balanced price ranges and all that stuff, and if you don't put it in the right order, in the right place, you'll still blow it. So again, I know some of you are impatient. You want to get to the next thing. There's a next thing every time I'm talking to you. And these are things that took me years to get. You're just looking at it and watching a couple videos and you think, okay, I got that now. You don't appreciate it. You don't know what I'm telling you and the importance of it. How many of you went back through price action and started looking for areas where we saw these back and forth ranges, okay, where it stayed in a range, and it bounced that range, and how price traded to it when it got there again? How many of you done that? Chances are not many of you. And that's what you're supposed to be doing. Just go into the charts and look at these signatures, because that's the only way you're going to learn them. You're not going to watch a video and say, oh yeah, I know what an order block is. Because if that was the case, they would all known it from Sniper. They don't. So anyway, I'm ranting on. Just know that we're still looking for this to pan out. It's just probably going to take a little bit of time until Wednesday, and then Wednesday's rate announcement for Canadian dollar should propel it down there. If it trades down there before that, it'll be interesting to see what we do, because at that time we could see a totally different market condition. If we trade down below that before the bank rate could end up sending it higher and attack the equal highs. I'm not saying it's going to move that far and that much, but at that time it completely changes everything. But we're looking for this run on these equal lows and try to get there this week on dollar CAD. And I think that's going to be it, folks. I will talk with you by way of the forum if anything comes up. And that'll be it. So enjoy your weekend, be safe, and I'll talk to you next week.